Hello, I am Dhrita Bharadwaj from the Department of Commerce, Tejpur University, Assam. Uh, this video is based on portfolio revision. So in this video, I shall be discussing in detail the meaning of portfolio revision, the need for portfolio revision, constraints of portfolio revision, revision strategies, formula plan, and assumptions to the formula plan. Beginning with the meaning. Portfolio revision is the art of changing the mix of securities in a portfolio. It involves a process of addition of more securities in an existing portfolio, or deleting existing assets, or changing the ratio of funds invested in the particular portfolio. In other words, the sale and the purchase of assets in an existing portfolio over a certain period of time to maximize returns and minimize risk is called as portfolio revision. Moving on to the needs for portfolio revision. Portfolio revision may be done due to various reasons, some of which are stated as under. Number one, availability of additional funds. An individual at certain point of time might feel the need to invest more. The need for portfolio revision arises when an individual has some additional money to invest. Secondly, change in investment goals. Change in investment goals also give rise to revision in portfolio. Depending on the cash flow, an individual can modify his financial goals, eventually giving rise to changes in the portfolio, that is portfolio revision. Thirdly, fluctuations in financial market. Financial market is subject to risks and uncertainty. An individual might sell off some of his assets owing to fluctuations in the financial market. Constraints. Constraints of portfolio revision. Firstly, transaction costs. Transaction costs are those costs that are incurred while selling and buying of securities. There are expenses related to certain transactions, for example, brokerage. Secondly, taxes. Taxes are required to be paid if there are short-term capital gains and long-term capital gains at different rates as per Income Tax Act. Thirdly, statutory stipulations. There are legal restrictions on the sale of securities and assets that are being bought earlier. Some assets cannot be sold until the lock-in period expires. For example, some mutual funds have a lock-in period before which it cannot be sold. Time value of money. The value of securities and assets bought in the past gets affected by the rate of inflation, and the intrinsic value needs to be compared with the current market price. Next, we have availability of additional funds for investment. In order to change or revise the portfolio, additional funds may be required which may not be readily available at the time of revision. Change in risk tolerance. The risk-taking capacity of investors may change with respect to time, and this change may affect the amount of funds that may be invested and the type of assets that form a part of the portfolio. Investors may be risk taker or risk averse. Thus, an investor who was a risk taker earlier may act in a risk averse manner and revise the portfolio accordingly. Change in investment goals. Investors and their investments are made with specific objectives. The objectives with which the investments are made may become redundant or change with respect to time. When the objectives or goals changes, then it shall lead to revision of portfolio. The portfolio, if was constructed with assets of short duration maturity as per a short time goal, and then the composition of the portfolio would change if the goal gets completed or changes with some other goal. Moving on to the portfolio revision strategies. There are two types of portfolio revision strategies. One, active revision strategy. It involves frequent or continuous change in an existing portfolio over a certain period of time so that the returns are maximum and the risks remain the minimum. The activity of revision of portfolio is carried out regularly. The basic objective is to beat the market. Secondly, we have passive revision strategy. Passive revision strategy involves rare or infrequent changes in portfolio, and if there is a need to change, then it is done as per predetermined rules. These predefined rules are known as formula plans. Thus, the revision is made as per already formulated rules. The formula plan shall be described in the upcoming part of the video. Formula plans. Formula plans are certain predefined rules and regulations deciding when and how much assets an individual can purchase or sell for portfolio revision. Formula plans help an investor to make the best possible use of fluctuations in the financial market. One can purchase shares when the prices are less and sell off when the market prices are higher. In formula plan, the investors divide the portfolio into aggressive and defensive portfolio. The aggressive portfolio comprises of the equity shares or stocks, options, futures, etc. And the defensive portfolio comprises of the safer and the stable securities like bonds, debentures, mutual funds, government securities, etc. Formula plans facilitate an investor to transfer funds from an aggressive to defensive portfolio and vice versa. The formula plans are used to help in making decisions for the future by exploiting the fluctuations in the prices. There are three formula plans and they are explained in short in the upcoming part. Number one, constant rupee value. The constant rupee value plan indicates that the rupee value remains constant in the stock portfolio of the total portfolio. Constant ratio value. Constant ratio value plan specifies the ratio of the value in the aggressive portfolio to the value of the conservative portfolio. Thirdly, variable ratio plans. In this plan, it is expected that the investor should sell stock and purchase bonds when stock prices rises. Similarly, when the stock price falls, stocks should be bought and the bonds should be sold. The formula plans work under certain assumptions, which are as follows. Number one, the stock price moves up and down in cycles. This means that there exists a cyclical movement of prices of securities in the market. A security should move up after it reaches a certain point downwards and vice versa. Secondly, the stock prices and the bond prices move in the opposite directions. It is understood that the bond prices and the stock prices are indirectly proportional to each other. That means once the stock price rises, the bond prices fall and vice versa. Thirdly, the investors cannot or are not inclined to forecast direction of the next fluctuations in the stock prices, which may be due to lack of skill and resources or their beliefs in the market efficiency or both. So in the summary, it can be said that portfolio revision is a continuous activity which needs to be conducted by the investor so that the returns of the portfolio remains on the higher side or it is constant and the investor is able to reduce the risk. Also, the investment pattern depends on the particular individual or the investor. If the investor is a risk averse investor, he or she is going to invest in those securities or assets where the risk is less. And if the investor is a risk taker, he or she is going to invest in those assets or securities where the risk is higher. But we should also know where when the risk is higher, the returns are more. In this presentation and video, I have referred to a book and some websites from which I have taken the resources and put up in the video. That's all. Thank you, everyone.